and welcome to one of our knowledge transfer sessions. Today we're going to be talking about required minimum distribution and is it a tax bomb? I'm going to butcher it all presentation long. Required minimum distributions. As before we get into the presentation, as always, the information today has to be general in nature. Tax situations can be very different for different people, and so when we talk about tax advice or giving some suggestions on this stuff, just recognize that your situation can be very different from the next person, and general rules of thumb may not apply to you. Just a real quick note about myself. I'm an independent financial advisor next to Overlake Hospital in Bellevue, Washington. I really enjoy putting on these videos for people and trying to transfer knowledge to the general public. My roots are really deep in Washington State, so a lot of our videos are going to be Washington State focused because that's the state we live in and have been dealing with for a very long time. The other thing is a quick note on anything around tax advice. When we talk about tax advice, one of the things that I always point out is it's complicated because you should really go through this grid right here. You should really understand what your current tax situation is. You should look at your goals. You should make some assumptions on how your money is going to grow. And then you look at reasonable alternatives. And if you can do that, you can have a really good, well-rounded tax situation. And you can avoid the basic problem that someone can promise you to save a whole bunch of money on taxes. And the easiest way to do that is lose money for you. The easiest way for someone to ever save you money on taxes is to make you lose money. So recognize that one of the ways to watch out for that is to go through this process right here. The other thing is this is tax planning, not tax filing. Tax filing is a very specific duty, and it's very specific at the time you do it. Tax planning is going to be less precise. We're going to be making some assumptions today, giving you rules of thumb, make future assumptions to try and get you really specifically down your path. But, there's a difference between that and tax filing. So what we're going to talk about today is we're going to talk about a quick overview of required minimum distributions. What are they? How do they work? Some basic ideas. We're going to talk about the concept of, is this a tax bomb? And then we're going to talk about some tips and tricks to prevent this from being a problem for you if it applies. And, in my practice, I deal with retirees or soon-to-be retirees all the time, and required minimum distributions as a topic comes up a lot. And when we talk about required minimum distributions, you need to understand some basic rules. You need to take withdrawals by age 73. The math here is pretty simple. You take whatever your balance is on 12/31 and you divide it by the IRS factor, and it tells you how much you need to take out for your required minimum distribution. Okay, and I would suggest just go online and use a calculator. I've used the tables all the time in the IRS, but I've graduated. I just use calculators now to look at this. The first year you need to take your required minimum distribution. You can actually defer it to the next year and take 2 in the next year. But after that, every year after that, by 12/31, you take out your RMDs. As a suggestion for retirees, when people retire, they have 401ks, 403bs, IRAs. They have their money spread out, I find. And this is actually the one time you kind of want things together because you can actually have one account satisfy the required minimum distributions for all your other accounts. As long as they're what's called like-titled. And so IRAs, as an example, would be like-titled. But an IRA and 401k are not. So you need to do each of them separately. And especially as people get older, I like to have lots of like-titled accounts to protect them. And this is very different from, say, hiring an advisor and consolidating all your assets and paying extra fees. There's still low-cost index funds or no-cost index funds, moving it to an IRA. And this is really the time we should talk about doing this because we're talking about required minimum distributions. Now, most of the times RMDs or required minimum distributions are at your tax rate. And this is the big concept you need to think about. 10%, 12%, 22%, 24%, and so forth. RMDs are, they're taxable income to you. And the taxes are basically unavoidable. If you don't take your required minimum distributions, you're going to face penalties, and those penalties are pretty steep. So, just recognize that you really need to take these out. Now, sometimes people die, right, and they don't take their RMD, and their heirs don't find out about it for a couple years later. There is an appeals process for reasonable heirs. Under the Secure Act 2.0, you need to take your RMDs before you do Roth conversion. So, if you want to do a $10,000 Roth conversion and you need to do a $3,000 RMD, $3,000 RMD comes out first, then you do the Roth conversion. And then we need to talk about the concept of, is this a tax bomb? And if you go out there, you're going to see a lot of articles from lots of places, Vanguard, Fidelity, NerdWallet, Kiplinger, lots of places talking about the tax bomb that is RMDs. And And really, for certain types of people, we call them higher net worth people, there can be some compelling reasons to move money around to avoid required minimum distributions, even for middle America or people who live at very low income. The problem is that the very specific group that are kind of gone after a vanguard, typically higher net worth people who don't spend their money in retirement, and that's very common. They have big IRA balances that grow, and then the money hits them and they have an RMD issue. Right, that's a very small subset of the overall population. Right, people who have so much money in retirement that they don't need to spend anything. Happens all the time. And as a financial planner, I run into it a lot because I tend to deal with retirees who are more affluent, but doesn't really reflect the average American. And then I was like, well, can I actually identify the math on how a required distribution can be a tax bomb, right? Because when we take money out for your IRA to live on, you're going to pay taxes. And if the government's forcing you to take money out, you're going to pay taxes. But really, for it to be a tax bomb, you need to be paying more in taxes than you could be. And so let's compare the difference between 22% and 24%, right? If you go up from the 22% bracket to the 24% bracket, and you need to take out a $40,000 required minimum distribution, and to take a $40,000 required minimum distribution, RMD, you need to have at least $1 million of IRA money, basically. Well, that additional taxation is about $800. And so that's the beginning of the tax bomb an extra amount here, about $800. And this can compound over time, especially if your money grows. And so you can see this extra taxation grow over time, but it's actually not a lot of money when you first start. One of the bigger ones might be Social Security. A lot of people retire and they're paying next to no taxes on their Social Security because that's what they're living on. And then all of a sudden they have to take this required minimum distribution. Even people who are affluent might have lived on cash and Social Security and be low taxation. And then all of a sudden this RMD hits and it causes their Social Security to become taxable. And when your Social Security goes from 0% taxable to actually taxable, that can be $5,000 of extra taxation you didn't count on. And then finally, there's Medicare IRMA. Now, Medicare IRMA is almost always cited in any RMD tax bomb situation because what happens is there's very specific limits: $106,000 for a single person and $212,000 for a couple. And once you go over this amount in income or modified adjusted gross income, you're going to start paying about an extra $1,000 a year in Medicare IRMA taxes per person. And the annoying thing about Medicare IRMA is it's a pinprick, right? When you get this letter out of nowhere and it says you owe an extra $1,000 in taxes next year, it's not very fun. So, you might have a tax bomb, if I was to quantify, in any one year of $7,215. Well, that gets my attention all of a sudden. $7,200 of extra taxation? Okay, how do I fix it? Well, this is where the problem starts to come into play. So if I want someone to hire me to fix their required minimum distributions, and I start with basic tax bracket planning, I might be saving you $800 in taxes per year over the long term. That can matter. But if I'm charging, say, 1% of an asset or a fee, or $2,000 a year as an annual financial planning fee to save $800 here, well, that might not be worth it to you. You better be getting a lot of value on the overall relationship. And I would argue I do give that value, but you might not find that value. Everyone's different. And just that right there, I don't think that's enough to fix anything. That's not enough for a lot of retirees to get up out of bed. For Social Security situation, the big number here, the $5,300, you actually need to be in a non-taxable Social Security situation. The average person retires, and if we're talking about the person with assets, they're probably spending some of their money and taking Social Security, and they're probably paying a certain amount of taxes on Social Security, and so the RMDs are probably not going to cause them to have an extra Social Security component to this. And then Medicare IRMA, the problem with it is this one really annoying thing. $1,000 per person a year for extra taxes, or $87.30 a month, might seem like a lot of money when you first think about it. But if you're taking out an extra $2,000 a month to live on, because that's what you want to live on, and you're paying an extra $87 a month in taxes, do you really want to live on $2,000 less to save $87? Maybe not. Right, so the problem with the RMD tax bomb is there could be some real numbers here behind the scenes, but everyone's situation is different, and you need to have some of these specific situations occur for you to actually have a problem. And one of the big problems here when we talk about this is, what you want to live on and your sources of income really does affect this, and it really changes the advice person by person by person. Person one's living on $5,000 a month. Person two's living on roughly $10,000 a month, right? They have very different advice and probably very different RMD issues based upon each of those individual situations. So you got to really look at, are you going to cause your tax brackets to go up? Are you going to cause Social Security taxation? And are you going to cause any other whole set of things? Extra taxation on capital gains, Medicare IRMA, things of that nature. And so when we get to this problem, the RMD tax problem, the problem of what you want to live on, what you want to live on and your overall assets kind of determine what you can do. So one of the most common ways to deal with a required distribution or RMD tax bomb is to do Roth conversions. That's take money out, pay taxes, and then convert it to a Roth where it's basically non-taxable at that point. And if you want to live on, say, $60,000 of income, and you wanted to maximize your 12% bracket for a single person, if you're living on cash, you can do fairly large Roth conversions. If you're living on kind of this combination of cash qualified, you could do smaller Roth conversions. If you're living on $60,000 qualified, or even Social Security plus the Roth conversion, you're going to be able to do very little Roth conversions at the 12% bracket. So what you need to live on actually determines a lot of the analysis around required minimum distribution tax bombs. And once someone's retired, they kind of get it figured out. But if I talk to a pre-retiree about what their budget is, half the time they have no idea, and they're just kind of figuring it out at that point, which means it's hard to do true analysis on this because you just don't know what your budget is. The other thing is to make a RMD tax bomb, and this is why people write about this, because the people who are going to typically have this problem are typically more affluent, right? If you have $1 million balance at age 73, you're going to need to take out around $37,000 for your required minimum distribution, which is less than the 4% rule. So if you're living on the 4% rule, you should notice that you're probably not having an RMD issue because you're already taking out and living on it. And so when you look at this right here, you're going to notice that, for there being an RMD tax bomb, you need to typically have $1 million balances or higher and not spend it. And once again, that's why places like Vanguard and myself, everyone likes to track clients who have RMD tax bombs, because you typically have bigger balances, you need service, you're trying to figure out how to make all this math work across an entire complex financial plan, and there's value there basically. But recognize, for you to even have to worry about this, you need to have more significant balances. And so if we're going to try and put some rules of thumbs into place, okay, how do we figure out, when do I need to think about this, right? Because I do math around this. I'm very specific by person, but you might not be, or you might just be getting your mind kind of wrapped around these concepts of how you want to handle this, right? And you're seeing an AI written clickbait article telling you about this bomb. It's giving you some couple bullet points, but no real math, right? So if you're actively spending your qualified monies, you probably are not going to ever have an RMD tax bomb, because you're probably already qualifying, or you're probably already doing it, and you need that money to live on, and your money is going to stunt growth because you're living on the money, so you're actually taking out some of your gains. So these are the people I have the least amount of worry about an RMD tax bomb. If it really grows, it can change the math. And sometimes RMDs are a problem because you just became wealthy. But generally, if you're spending your money, probably not going to be an issue. I find Medicare IRMA is a really good predictor of kind of what I want to do around this. So if you're living on $106,000 or less as a single person, or $212,000 or less as a couple, you typically want to, and this is a really good predictor around RMD issues. If you're living around these amounts and you're not spending your money, it's probably going to grow, and you're probably going to start triggering at least Medicare IRMA later on. So, if you're looking at your income amounts, you're like 106 or 212, I'd probably start paying attention to this, because you're going to run into some tax bracket issues slightly, the $800 a year there that grows over time, compounding. You're going to look at Medicare IRMA. There's thousands of dollars there that you might want analysis on. Once again, though, thousands of dollars, it's a good idea. You should really hit that. But if you're hiring someone like me to do it, that should be part of the overall package. Some other rules of thumb: if you're really thrifty, you're going to probably have an RMD tax bomb. If you're not spending your money very much in retirement, you're living on your pension, just letting your money grow, you're going to have an RMD tax bomb. Social Security interferes with your calculations. So typically, if you're going to do fixes around this, you're going to want to delay Social Security. It's one of the big reasons to do it. Medicare IRMA is really annoying. But recognize that you have to get past certain amounts before it becomes an issue for you. And when we talk about basic rule of thumb, whenever you can take money out 12%, do it. 22 probably should do it. 24 maybe should do it. There's some personal choice there. Recognize when you do Roth conversions, a lot of times you're helping out the next generation, not you. But this is some general rules of thumb. You should consider doing this. Now let's talk about some basic tips or tricks to kind of go along with the general advice you see out there. So this is going to be a little bit more specific. Some tips and tricks in here that I think that I do in my practice on top of the generic advice. So first, you're going to take your funds out 12, 22, and 24%, convert them to Roth. You no longer have to worry about RMDs on these funds because your heirs are off, and your heirs are going to be happier because they're going to get them tax-free someday. So, cool. But you probably aren't going to get the benefit as much here because, once again, RMDs are more for your heirs and really elderly people than for the majority of your retirement years. Remember, Roth accounts are going to have a 5-year clock, so if you just open one today, got to wait 5 years before you can really take the money out. That's why you should always have a small Roth IRA opened early on in your life so that you've kind of expired that 5-year Roth clock. Watch out for net investment tax. You can trigger 3.8% net investment tax on other assets if you try and do aggressive Roth planning. And, let's say you save $800 in taxes for 15 years and compound it. At 65, you're going to probably need to get to age 80 before this really starts to build up, right? So, like I said, more of the benefits for way later in life or for your heirs. All right, so now let's go through some more fine-tuning. So when I set up someone's retirement, I often run into people who have assets like this, or some subset of this, right? Where they have some cash, they have some brokerage accounts, they have 401ks, IRAs, and the majority of their money is in 401ks and IRAs oftentimes, unless they're a tech worker who has a lot of RSUs. And what you're supposed to do is in retirement, you're supposed to diversify this somehow. And most would say some type of 60-40 blend where 60% is equities and 40% other, basically, right? And what you can do here is if you can adjust this appropriately early in retirement, you can actually avoid the Roth bomb later on. Because what happens is a lot of times people have their cash here, and that should be typically your more aggressive investments that aren't generating income. Cash generates income. It generates passive taxation. It's like one of the best things to inherit is cash that you've converted to stocks. And so what you typically want to do is your cash and CDs, you want to take them and make them more aggressive investments. Same with your brokerage. You want them to be more aggressive relatively. And then you want to put all your conservative stuff that you should have anyway in your IRAs. And what that does is it tends to stunt the growth of your IRA. And at the same time, it's going to make your other money grow more aggressively, right? And then when we get to the problem of spending your money, typically I find people spend the wrong money first. Typically you're going to want to take that out of your IRA and avoid activating Social Security, then activating Social Security or spending your cash or brokerage accounts. So you have this combination of putting your more aggressive investments outside the IRAs, putting your more conservative things inside the IRAs and stunting the growth, and then spending your IRAs more aggressively early in retirement. If you can kind of do those things, if you can kind of do this different blended concept here, then you can kind of fix the RMD tax bomb early on. The other thing too is that make sure you put your stuff in IRAs. I preach this all the time. Your old 401k may have the perfectly cheapest fees possible, and you may trust it implicitly because your money's always been there and it stresses you out to move it, but you should move it in an IRA. This is the time. You're going to get old someday, and dealing with this out of 3 different accounts is just setting yourself up someday to have a big tax penalty because someone couldn't keep track of it. So, consolidate all these into IRAs. the 3 bottom accounts, and then reallocate everything appropriately where your safer income-producing assets are inside your IRA so that it stunts their growth. Some other little things, if you're charitably inclined, make sure you take the money out of your IRA directly and pay it to something like a church. That's a new law that was put in effect like 3 years ago, and I rarely ever see someone talk about this. But if you're putting $5,000 a year to a charity, well, that should come out of your IRA, because that first $5,000 will satisfy your RMDs and be non-taxable if you pay it directly from your IRA. It's a really good idea. RMDs do need to occur before you do Roth conversions, so watch out for that little problem. And then when you finally get to the point where you're doing these required distributions, what I do in my practice, and you should be doing this too, is I have it automatically done by the custodian and then automatically reinvested in a brokerage account. You can always spend the money, and you should. That's most optimal, but I find people have trouble spending their money. So set up an automatic reinvestment plan, protects you when you get older, and have this all automatically done for you. And when it comes time for you to spend your money, just spend it. So we're here to help. If you have any questions, feel free to drop us an email or call sometime. We'd be happy to chat with you and just kind of go through everyone's situation. Could be different. But I hope today's information was helpful. Just kind of talk about required distributions, some of the basic concepts or theories of what to do, and just a basic overview of this. So, we'll have some more knowledge transfer videos for you coming up, but thank you for watching.